Welcome everyone. It is time for another thrilling edition of Patreon member questions and answers, where my Patreon members ask me questions and I, based upon my 29 years of trading experience, attempt to answer said questions. This is not investment advice, just sharing my opinions. Is for education and entertainment purposes only. And if you want to ask me a question, feel free to join my Patreon. Link in the description below. There's a 7-day free trial. Now let's get to the questions. First question from one of my longtime Patreon members, Leanne. I don't know if you can see that. Maybe not, but I'll just read it to you. She asked about BJ. We'll get to that one in a minute. Second question she had: when a stock on your focus list gaps up in the morning on earnings, how long do you wait before you buy it, and how much of a gap up is too much for you to consider it no longer buyable? Okay, so I'm going to tell you two things. The first one is Mark Minervini's classic line. I was a member of Minervini Private Access for almost 3 years, and he got asked this question all the time, and his answer always was regarding gaps. He wants to be in before the gap happens. And sometimes you can do that, sometimes you can't. Here is the Google initial IPO, and as you can see, major character change and break of all three moving average lines on volume. So you could have gotten in there right there with a nice cushion going into that gap. The second thing I want to say, which is true for so many different aspects of investing, and that simply is it depends. It depends on the strength of the market, depends on the fundamentals of the stock. But I'll give you a couple hints here. Okay, so let me give you 5 strategies here. Number one, the strength of the market. If the market is strong, like it is right now, gaps are much more likely to hold up and go higher over the course of the day. Conversely, if the market is choppy or weak, then all gaps should be suspicious and they are apt to fill. That seems pretty common sense, but it's easy to not think about the quality of the market when you see a gap, because they are exciting things for sure. Second thing is, why did it gap up? Is it a major positive character change? Did the company come out with an unexpected surprise announcement? Is it just gapping up with the general market? The former would be a much more powerful reason than the latter. Most gaps take place on earnings releases, but sometimes you get a surprise product announcement, or a company revises their estimates upward, or some sort of surprise strategic event. So the next one is volume. I have market surge, which not only gives you the current volume, but it gives you an estimate of. The next thing you want to look at is volume. I have market surge, which tells you at any given time whether the volume is above average, and if so, to what degree, or below average. If you don't have market surge, there are countless different ways you can find out if the current volume is above average or not. I'm sure you could even just use ChatGPT or Grok and say, is the volume in such as such stock above average right now? Anyway, if you see that the volume is way above average, 100%, 200%, 300%, then that's a great sign. That's almost certainly institutions buying there at the open. And so that would make me quite eager to buy at the open with them. If it says that the volume is below average, or maybe plus 10% or something, then I probably would give it a little time and see if both the price and the volume pick up. Now, of course, I have the luxury of watching the market all day, so I can do that. If you can't watch the market all day, you're going to have to set buy stops and so forth and hope for the best, which is a disadvantage, but you have advantages. For instance, you don't get shaken out on panic intraday moves. Let's see, there was one other one. Okay, so technically, the wider and the shallower the base, the more significant the breakout is. This was a great breakout for Oddity Tech here because you had this really long, almost a year-long base and really pretty tight, and then suddenly broke out of this trading range. That's a much more powerful breakout than if you had a stock that was oscillating wildly and then put a little 5% gap up on top of that. So the quality of the width and depth of the base. As far as gaps, I hate to chase gaps. Sometimes I do if it's one like this with this really nice wide base. Like I said, the smaller the gap, the better, because then you can control your risk better, right? Like if Oddity here opened at 60 and the previous day it was down here at 48, it could come down all the way to like 53 or something and still be a positive move. Meanwhile, you'd be sitting on a big loss if you bought at the open. I could rattle on about gaps all day, but breakaway gaps or breakout gaps can be really powerful. Here, Google's famous great breakout gap from its IPO base, and you know, the rest was history. This stock has gone up thousands of % since then. One thing I'll mention also is a lot of times you won't see the gap until not only has it gapped up, but it's run up quite a bit. This ran up, let's see, how do I do this? Oh, about 5% there. It usually gives you at least another day to get in. So if you didn't see it to up here, as you can see, it traded inside for a few days and undercut quite a bit, probably shook everybody out. Sometimes it doesn't do that, but a lot of times it will trade inside for a few days and then start drifting up. So don't panic if you didn't buy on the gap up day, or if you just put on a piece. Usually you'll have plenty of time. I'm gonna have to turn that off. Hold on. If the stock is going to be a big winner, it usually will give you another opportunity. In Google's case, this was actually kind of a base on base. Here's this long wide base and then second base, and this one gapped up as well. Meta broke out of a long IPO base as well, and the next day it traded inside, and then when it moved above the prior day's high, that's probably where you could get in. And as you can see, you know, it was quite a while, quite a few days before it really took off. And of course, it's been going up and up and up. Here's another example of a gap, EHC, nice wide base, powerful gap up, closed within the top of its range. And then if you missed it the first day, I probably would start adding some the second day when it's obvious that it is showing some extension or accumulation. So as Mike Webster, IBD, original gangster, says, volume nowadays is not as, he says volume is dirty back in the 90s. And even maybe 10 years ago or so, the volume was very, there was no way to hide volume. But nowadays with deep pools and so forth, sometimes a lot more volume buying can be going on than the chart will indicate. So don't necessarily rule out buying a gap or a good move in a stock if the volume isn't there. Hakan, one of my other Patreon members, mentioned, how do you look at volume for breakout trades at the open? Isn't it unclear at opening that the volume will skyrocket? Yeah, it definitely is. This is all about making calculated risks, figuring out what the probabilities are. And like I said, if it's a nice gap up and there's big volume at the open, then I probably would jump on it with part of my position in a 5% stop, and then, you know, hope and watch. Conversely, if the volume isn't there, then I would wait a few minutes to a few hours, maybe even to the end of the day, and see if the price drifts up and the volume picks up. But yeah, it's all about probabilities. It's at the open of the market. I mean, we have some hints as to what's going to happen over the course of the day, but it's always unclear. Then the other thing Leanne asked is BJ's Wholesale Club in a trend channel? Let's take a look at it. Let's look at the monthly. First of all, IPO base, maybe we call that a second base, debatable. Third base, definitely extended here. Certainly would be better to have gotten it right there, right there, right there. But the best stocks can do 5, 6, even 7 bases before they move into some sort of stage 3, stage 4 rollover. Looking at it on the daily here, yeah, we can call this a trend channel if we want to get creative. Here's our upper trend line. Here is our lower. Let me try that again. Maybe we call that our lower trend line. If we do that, this is almost, see how it's widening out, see how it's fanning. That is actually kind of a negative. This ascending widening fan is ultimately bearish. Also has a smaller trend channel. So you can try to trade trend. Wow, it's hard to say. You can try to trade trend channels unless it's a really clear one. A lot of times, in my opinion, trend channels are easy to spot in hindsight. You know, sell here, buy here, sell here, buy here. But in real time, I think you're a lot better off looking at support and resistance lines. Right now, here's your resistance line, getting support on the 50-day. So you buy off the 50-day bounce, or you buy handle breakout there. I do, every once in a while, you'll get a really tight, perfect trend channel. Like see 𝐿F in 2022. When you get a perfect trend channel that's just, you know, a third grader could see it, then you can do pretty well trading trend channels. But trend channels, a really defined one like that is actually pretty rare in my anecdotal experience. Okay, next question is from Rick. Hi Joe, what are your thoughts on Minervini's trend template? I saw a video where he stated that his buys must meet these 8 criteria. So first of all, Mark Minervini's been the most influential trader on me out of all of the famous traders. His 2 books, 2 trading or investing books are kind of like the holy Bible of investing. I think you should read those many times, really. And then, like I said, and I think that any sort of template checklist like this can be helpful for beginners. Ultimately, when you become really skilled at this, it's kind of like you know it when you see it, right? A dermatologist doesn't have to go through a 10-step checklist to decide if a spot is cancerous or not. They know it when they see it. And eventually that's where you will get. I think that his trend template is a little overly complicated. If you really did this for every single stock you were evaluating, it would take forever, and you might end up missing out on some good trades because it doesn't meet one of these characteristics. I would simplify it. Let's see. I don't use the 150-day. I use the 21-day simple, 21-day exponential moving average, 50-day simple, and 200-day simple. And I want those stacked. I want the 21-day above the 50-day, above the 200-day. And ideally, I want all 3 of them trending upwards. Yeah, all 3 of them trending upwards, or at least turning upwards. The 200-day trending up for at least a month. Yeah, that I'm a big believer in that. You want it to have an established uptrend and some bullish momentum, and that is the case when the 200-day has turned up for at least a month. For example, I've been watching Dollar Tree really carefully, starting to get a little uptrend here, but the 200-day is still in a downtrend. I would rather buy this at a higher price once it gets a little bit of momentum and that 200-day starts turning up. Let's go back to that trend template. Let's see, current price of the 50-day, yeah. And then current price at least 30% above the 52-week low. We want to see it moving up the right side of a base if it's not making new highs. And that's there's kind of an art to that. I can't really get bogged down in that too much. But this is a good starter rule for sure. And then, yeah, in general, you don't want to buy a stock that's more than 25% off its 52-week high, because then there's too much a near-term supply. Like here's NVIDIA. Some people are thinking we should buy NVIDIA now because it's kind of looking like it wants to start going up, but it's still 25% down here, and you've got all of these trap buyers, many of which are still holding stock and are going to sell as it rises. So it would be better for more time to elapse, move sideways a while longer, price to come up a little bit higher, get that 50-day turning, get that 21-day above the 50-day, above the 200, etc. And then this is surprising, relative strength 70 or higher. I've heard him say, I wonder if that's right. Hopefully Grok is right on this. I'd have to check the book, and I'm not going to right now. But I've heard him say for beginners, 88 or higher. And if you have a screener, just set your screener to only show you stocks relative strength 88 or higher. Once you become intermediate or more advanced, then you can lower that number to 80. But we definitely want to be buying stocks because that'll give you some of these flat-based breakouts. Like, let's look at, now I'm curious, ODD. Okay, relative strength 97, but maybe it wasn't down here. But we want to be buying the best merchandise in the store, right? The stocks that are outperforming almost every other, the stocks that are outperforming 80% or more of the other stocks. Why buy a laggard when you can buy a leader, right? So if I can summarize that, we want 50-day above the 200-day, and preferably the price above the 21-day as well. We want all three of those turning up. We want a stock working up the right side or making new highs less than 25% from the bottom. We want relative strength of 80 or higher. 88 or higher is really best. Okay, Miko says, general thoughts on market surge growth 250 list, and how could we find alternatives of that list somewhere else? So market surge growth 250, of course, is a good list. Shows, in theory, 250 of the fastest growing, best companies in America. But in reality, we can find and screen lists of good stocks very easily with all sorts of different software platforms. And Miko, I've subscribed to Market Surge since I think like 1998, back when it was daily graphs. And I did pay for the extra pattern recognition add-on and the Growth 250 add-on for a handful of years, but I don't even do it anymore. It is so easy to find strong stocks nowadays. Now, I'm not sure if you have Market Surge. If you do, there are all sorts of different stock screens. You can build your own screens. You can look at the industry groups here and pull up strong industry groups. I could do a whole video on all the different screens and reports in Market Surge that are not the Growth 250. If you don't have it, if you don't have access to the Growth 250 list or other lists of fast-growing stocks, and you don't have any sort of stock screener, all you really need to do is pull up the S&P 500 and or the New York Stock Exchange and just screen it by eye. So stockcharts.com makes this really easy. They have this scanner here, and you can have it pull up every symbol in the S&P 500 or in the New York Stock Exchange, and I've already saved the list down here. Here's the S&P 500 at small cap 600. You can also just do a screen by relative strength. If a stock has a high relative strength, it probably is growing rapidly. But let me just show you here. If I pull up the S&P 500, then if I go into this candle glance mode, then it will organize it in strongest charts to weakest charts. So then here, these ones that are extended, these would be watch list stocks. And then I just look for stocks coming out of bases, like Philip Morris came out of this little base. Click on it. What else? Let's see, I don't want to kill too much time. Electronic Arts breaking out of this base. FICO working up the right side of a base. And just go through it by eye. And you can do this. You can go through all 500 stocks in 10 minutes. Find yourself some good-looking longs and some potential good-looking shorts. And you will find by eye the fastest growing companies in America, public companies. Let's see, if you don't have market search, I mean, Yahoo Finance has free screeners here. My partner Seeking Alpha Premium, link in the description below, also has a pretty good screener. Yeah, honestly, finding the good stocks is not the problem. It's determining the entry points and then managing the trade. That's the hard part. Okay, Shaw said he wants me to look at Archer, MPTI, forgot what that one is. Costco, been in and out of that one many times. I should just buy and hold it. Do you always make sure a stock is above its 2150 and 200-day moving average prior to you buying it? So I sort of touched on that earlier. As a beginner, I think that's a good rule. Once you get pretty good at this and have some years of successful trading, you can bend the rules occasionally a little bit, but in general, yeah, you want those stacked 21 above the 50 above the 200-day, and ideally they are all turning up. At least you want the 200-day in an uptrend. Let me show you. I show my Patreon members a list, a focus list on that I show every weekend, and let's just click through some of these and just look at the moving averages. So green's the 21, red is the 50, black is the 200. So here's Palantir, 21 above the 50, above the 200. They're all turning up. Oddity we've already looked at, 21 above the 50, above the 200, all turning up. Hood, 21 is just about to cross the 50, 200 days going up, 50 days still moving down. That indicates this is probably going to need a little more time sideways, right? LTH, 21 and 50 day flat right there. 200 day in a strong uptrend. This actually looks buyable except for earnings. So that one's bending the rules just a little bit. That's a new issue. LRN, 21 above the 50, above the 200. All of them are turning up. DRS, 21 above the 50, above the 200. All turning up. So in general, yes. And you definitely want the 50 above the 200, and you want the 50 and the 200 turning up. Okay, let's look at Archer. I think isn't that one of the electric vertical takeoff and landing companies? Yeah. This huge prior move, some choppy sideways action, came down with the general market. It's definitely looking constructive. We're seeing this in a lot of different stocks. I was checking to make sure the camera was rolling. That would really suck to have to redo this. Double bottom, second bottom undercuts the first. Nice shakeout, uptrending 200-day, relative strength of 98, working up the right side. Just cleared some supply, popped back into the base. Earnings coming up in 7 days, so right there, I would probably wait for earnings. Let's pretend earnings weren't there. The next thing we want to do is measure ACHR. Market Search does not have a measuring tool, which is irksome. We are, let's see, this base, 57 31% deep. So that's unusually deep. Now it is at 31% deep. So it's still pretty deep. And see all this supply? See this volume bar? I personally would wait for it to set up here about 950, 975. So maybe something like that. And then breakout on earnings. But yeah, keep an eye on that one. That's an exciting one. Joby's another one. Joby. Way low in the base right now. And 𝐴𝐻, Chinese version, doesn't look that great at the moment. MPTI, aerospace and defense, super hot industry, communication. Let's see. Good earnings and sales, profitable company. Earnings are coming up. I probably would wait, honestly. So it's working up the right side. That's the good news. Bad news is, see how this is wedged up with no check back? So we really either need to see a more substantial handle or a partial check back, maybe down to that 21-day line. Maybe let that 50-day get above the 21-day line. This is looking a little... we got all this supply here and all this supply here. I probably would wait for it to get up there. So we draw a line there. Maybe this gives us a nice handle, right? And we buy it when it breaks through 60. Mtron Industries, recent IPO, that's good. IPO base, second base, working on third base. Earnings line looks good. Fund acceleration, good. Management owns a piece. Costco. I was actually thinking about buying this one today, but being patient. I don't want to get too many stocks in my portfolio. We're seeing two patterns right now, two constructive patterns. One, the double bottom breakout with or without a handle. Two, failed head and shoulders tops. Shoulder, head, shoulder broke to the upside. What's keeping me from buying this right now is this gap and all of this trap supply. I think it's probably gonna make a cap right here and then come up, test that supply, do something like that. So I would probably wait until we get that move right there. Now if we don't get that, if it just blasts up there, then it'll probably check back, make a handle up there. Let's see. This is, I actually wrote an article about this Costco on Seeking Alpha. You might want to check it out. Basically, I talked about the earnings stability. This is a slow grower, single-digit earnings and sale growth, but it's so stable. Its earnings are very predictable, more predictable than 96% of stocks. And institutions love that because they can put it on their spreadsheet. Fantastic long-term chart. This is one of those few steady Yeti stocks that have been and seem to still be so rock solid. You could really just make a case for throwing technical analysis out the window and just buying a piece every month or every other month until there's a major character change. Okay, easy question here. Thanks. Question on the ANTS indicator on market search. This is a cool indicator they added just like a year or so ago. It's a David Ryan invention. And I'm trying to remember. I think it's if a stock has gone up 12 out of 15 days in a row, then you get these ants, these little black ticks. This is LRN stride. Now, what has been figured out is you don't actually want to buy it when these ants start appearing. When that happens, it's almost certainly overbought. What you do is you wait for the pullback and then the bounce. So in this instance, you probably would have bought right there. Although if you were insightful, you would have realized the market was starting to come down and you wouldn't have. But so you wait for a pullback and then a bounce. So maybe we buy right here or we buy right here. Then we fill out the position here, get squatted on, but add to it right there. Let me see. There's a few others with, I think, LTH, oops, LTH. Yeah, here's some more ants. So you don't buy it when you're seeing these ants. You wait for the pullback, and then you buy when it's on the right, working up the right side. Now this is a really tricky one. This is a really wild, maybe not the best example, but essentially we got, what do we have here? Head and shoulders, right? Let me erase that. Shoulder, head, shoulder, shoulder. Nice pivot area. Buy right there, except earnings. You got to watch for earnings. I would wait on that. But if this makes us a nice cap and then a breakout, that's where we buy it. Okay, my thoughts on crypto stocks like Mr. and 21 Capital, newly founded 21 Capital. So first, I generally don't, in fact, I never buy a stock on IPO day. I let it make its first IPO base. I think 55% of the time they end up lower than their IPO release price, and you want to see that initial base form. Regarding Bitcoin, I'm by no means an expert. I have invested or wasted, depending on your opinion, many hours thinking about and studying it. Ultimately, I don't know, and I don't think anyone knows for sure. It seems to be ultimately a binary vehicle where long term it's either going to go to 1 million plus or zero, maybe 60% chance it goes to 1 million plus, 40% chance it goes to zero. So one thing you could do is just accumulate a little bit of Bitcoin every year, every few months, etc. That's not what I do though. I trade it using the technicals. If you look, here's the 10-year chart of Bitcoin. It trades very much like a stock. This is a faulty base because it's too deep. But here you get a nice shallow base with a handle with a shakeout. That's very tradable. You buy it here, head and shoulders top, sell it there. Here's another double bottom base, very buyable right there. Nice base here, kind of a head and shoulders, inverted head and shoulders, etc. Making a cup with handle here. So I just trade it like a stock, and I use. I know you can buy actual Bitcoin with hard wallets and all that nonsense, or buy it indirectly through PayPal and stuff. I just buy the ETF. There's quite a few ETFs. I use 𝐴𝐵IT because it's got a very high float, and so a tight spread between the bid and the ask. Mr. is basically just a leveraged version of Bitcoin, kind of playing like a leveraged ETF almost. So it is tradable, but the average true range is wild. But basically, it goes up when Bitcoin's going up and down when Bitcoin's going down. But it moves faster in both directions than 𝐴𝐵IT. And right now, I do have some 𝐴𝐵IT. And like I said, trying to make this cup with handle. A lot of supply here, looking left. Let's see here. Hakan also had a question on MRCY, Mercury Systems. Bought it April 23rd at about $49. General thoughts. And now you're just getting these dojis. Yeah, that's because it's going into earnings. Usually, not always, but usually a stock will stall out and make a pivot area before earnings. So if earnings weren't coming up, I would say this is a great buy. Hot industry, aerospace and defense, companies making money, triple-digit earnings, strong relative strength, cup or double bottom with handle, nice pivot area, shakeout in the handle, breakout. You bought it here, 423. Now this squatted, but you didn't know that at the time, and then it did recover the following day. But this is only a week or less in front of earnings. You have to ask yourself, can I get 2x of my risk, that is like 10%, before earnings? And if you don't think you can, then it's really not worth the risk, in my opinion. For many years, I was negligent in checking earnings dates and would accidentally buy before earnings and then get absolutely blasted on a gap down, or realize what I had done and end up selling for a small loss. So during earnings season, you got to be cognizant of earnings dates, and you can look them up on the company's websites. You could just ask Grok or ChatGPT. Market Surge, as you can see, has the information right here. So what do you do now? Well, you're in a pickle. You are up a little bit here. MRCY. Yeah, so you're up about 3%. I'm not gonna tell you what to do. I personally would not buy so close into earnings, and if I didn't have a 5% profit, I personally would sell all or most of the position. But I don't want to tell you to do that, because if you sell and it gaps up big time, you're going to be pretty upset. So do what you think is best, but those are some guidelines for the future. Great looking company though. Nice earnings line. Newly moved into stage 2, kind of inverted head and shoulders there. This is definitely one. Ideally what we see here is a little handle. Oh, earnings is tomorrow actually. So I don't like how this handle's wedged up. That's a negative. Still might work, but it would be better if the handle was wedged down. Now, this is also pretty extended. If I own this, like let's say I bought it right here, if we got a big gap up, I would be selling a piece at the gap. Yeah, that's just what I would do. Okay, take 2, and then a final difficult question. Let's see. Yeah, take 2 was a great looking chart. They are going to release arguably the greatest best-selling video game of all time, GTA 6. And they just announced a delay. See this gap down? They're bumping it back like 6 months from fall of 2025 to May of 2026. What was the question here? The stock slipped 11% and shares were bought up again. Is this positive or negative? This is negative. A gap down is always negative. And this blew up a wonderful chart, right? You had this inverted head and shoulders, shoulder, head, shoulder, breakout, extension. And then what would have been great is if it just kept going and then rolled back quietly. And then you can add on when it resumes. But here, the price is coming up into this gap. All of these bag holders are going to be selling into that gap. Traders who bought it here are going to be selling at the gap. It's going to struggle. Now, sometimes the stock will just power through, but usually the gap gives it trouble and it gets pinned over here for days, sometimes weeks, sometimes months. Well, let's look at CrowdStrike in just a second. Earnings coming in 10 days, maybe that'll power out of there. Now, yes, we've seen accumulation here, but I've seen Minervini many times when he got caught with a gap like this, when it bounced and he got up near break even, he would sell because, like I said, this is a broken chart now. So I would wait and give it some time if you're not already in it. Let me show you. Let's just look at something. Yeah, see this gap down on CrowdStrike? It took from mid-July for this stock to really to fill that gap. It took from July to November. It took months. So now this is just one example, but those are my thoughts on that. Okay, now last question. Let me circle it here. What are your first actions when you hear news like DeepSeek, except be patient? How do you classify it? I mean, new news, difficult to interpret. Yeah, the DeepSeek event. Hold on, let me get the old NASDAQ. So let's see, news events always trump the technical pattern preceding the news event. This was the DeepSeek event, basically when China announced they had powerful semiconductor chips that needed drastically less computing power and energy. This was a black swan event that instantly undercut the demand for all of the semiconductor companies and semiconductor power companies. And this really killed the rally. So here's the NASDAQ. So J. Powell turning hawkish. That was the first nail in the coffin. And then here's that 𝗕𝙂𝐸𝐾 gap down. So in general terms, when you get a really unexpected news event that the market reacts dramatically negative to, that is a major red flag. And in hindsight, we all should have turtled up, taken partial profits, raised our stops, maybe gone immediately to cash. If we had just gone to cash here and then waited for this base to break out, we would have saved a 20% loss there, right? What are some other famous black swan events? September 11th, the COVID lockdown announcement. So those are three. When you get something dramatically negative and completely unexpected, I think the 𝗕𝙂𝐸𝐾 announcement came from completely left field, then I think we want to get really cautious. And other than perhaps, your long-term index funds, and maybe if you have something like Meta or Amazon that you've been building for years, any of your swing trades, I would just close them out. And I did what I said you should do to a lesser degree, but not as emphatically as I should have. And I did suffer some drawdown here as I got out of stocks. Black swan events like that are really rare. Yeah, I mean, even like this negative Fed day, we knew that he was going to come and speak, so we could be ready. But every once in a while you get, like I said, the COVID lockdown or September 11th, or in this case 𝗕𝙂𝐸𝐾, and it just blows up the market. Now, increasingly, it's looking like 𝗕𝙂𝐸𝐾 is overstated or perhaps even fraudulent. That's one reason the market and things like NVIDIA are starting to recover. I think that's all I want to say on that. And I think, let me see. I think that's all of our questions. I hope you guys got something out of that. If you are interested in seeing my portfolio and focus list each weekend and seeing some midweek videos and stuff like this, please subscribe to my Patreon, link in the description below. Check out my partner, Seeking Alpha Premium, link in the description below. See what they're saying about Take Two right now. GTA will be huge, but it may not be enough. A lot of times you get a sell side argument and a buy side. I like to read both sides of the argument. Let's wrap it up. Let me know your comments. As always, I'll see you in the next video.